Recording.
Never a dull moment here with Ask the Expert.
Mm-hmm.
Dun, dun, dun.
Okay, here we go. All right. Once you see the live on Facebook icon, you can go ahead and get started.
All right, everybody. Welcome to another episode of Ask the Expert with the Martin Eiden team. I apologize, everyone, for not having my face here today. I'm actually driving to a listing appointment, which is good. That means the market is back. Very exciting. But today, I'm really happy to announce Eric Brecher, who's going to talk to us about 1031 tax exchanges. A lot of you may be asking, what is that about? How does it happen? But Eric, why don't you give yourself a little bit of introduction about yourself and who you work with and all that jazz.
Terrific. Well, Martin, thank you for having me here today. And so my name is Eric Brecher. I'm an attorney and also a certified exchange specialist with Wintrust Bank's 1031 exchange group, CDEC 1031. And so we serve as a qualified intermediary for 1031 exchange transactions. We are one of the oldest and largest qualified intermediaries. I personally have been handling exchanges for over 15 years, and the company has been handling them for over 30 years. And so you may be asking, well, I have an attorney, and so that's great because you're going to need an attorney to negotiate the contract. When Martin and Company finds you property to buy or they sell your property, I don't negotiate contracts or handle closings. My role is to set up the 1031 exchange, and then equally as important, we hold the money after the property is sold until you're ready to buy the replacement property. And so that's a function that anybody that has served as the taxpayer's agent over the prior 2 years is not permitted to perform. So the attorney, the accountant, you guys as the realtors are not permitted to perform the function that I do.
Fair enough. So I just want to back up a little bit, right? So, or to the very beginning. So, as I'm sure everybody knows, if you are selling, an investment property, you are subject to capital gains, correct?
So,
Eric,
yeah,
traditionally,
that's just one of them. So, of course, you have federal capital gains tax on your appreciation. There is also state income tax, of course, assuming, we're talking about New York or other states that have a state income tax. Florida, Nevada, those do not, as well as some others. But so you have the federal capital gains tax, you have state income tax. There's also a net investment income tax, which is 3.8%. And lastly, for investment property that has been depreciated, there is a 25% depreciation recapture tax.
Got it. So that, and as everybody who knows me, although I'm a big flaming liberal, if I don't have to pay taxes, I don't want to, like everyone else. And is there a way to defer all of those taxes that you just talked about?
Yes. So fortunately, Drew, and why we're here and talking about this. Yeah. So
right.
Section 1031 of the tax code provides a mechanism to defer paying those taxes when investment property is sold, and investment real property, and investment real property is acquired. And there are certain rules and time periods. And this is something that's been around for 100 years. This was in the code.
I didn't know that.
Yeah, it was put in the code in 1921, albeit a different section number, but a mechanism to provide the continuity of an investment. And up until the Tax Cuts and Jobs Act, which went into effect in December of 2017, effective January 1st of 2018, up until that point, you used to be able to do 1031s of machinery and equipment, aircraft, artwork, all sorts of things. But As of January 1st of 2018, only real property, which is all that you care about, right? So that's
Right, right. Well, that's interesting. I didn't know that. That's interesting that all happened, right? So for example, and then again, what is considered an investment property? Is it only limited to, I own a strip mall, or I own land under a Walgreens that's got a 25-year lease, or what is considered an investment property, Eric?
So the great thing with real property, and we did just recently, through some final regulations, get some clarity to what real property means. But in a nutshell, all real property is exchangeable and like kind to all other real property. That's a common misconception, that I'm selling a condo and I only have to buy another condo. That is not the case. You can sell that condo in Manhattan that you have been renting out to somebody and go buy a piece of property in Florida. And that could be a shopping center in Florida or a hotel in Florida. I mean, tremendous flexibility. Could even be a piece of raw land. Even raw land is like kind for 1031 purposes.
Wow. So that's great. So for example, and I think you have a great example coming up, but this is for people, and the show today, we're going to talk a little bit about people that may have a second home or condo and how to do a 1031 on that to defer, all the taxes that you would normally be subjected to. But we had a little bit of a pre-show that and Eric and I were talking. And Eric, tell us about your client that has a multifamily that they just put in a contract for $4 million, but they were living in it, and they were able to put a number of that or a portion of that into a 1031. So
yeah, so I was sharing with Martin that I just got off the phone before this call with somebody that's selling a $4 million four family, and they lived in 25% of it. So
okay,
for people's primary residences, 1031s do not apply. It has to be property held for investment. So that's typically going to be something where there's been rental income. That's what we would expect to see, right? I mean, raw land, unless it's a parking lot, you're typically not going to have income from that. So, but that's okay. But for people's primary residences, there is what's called the Section 121 tax exemption for single people. The first $250,000 of their gain is tax-free, and they don't need to reinvest. And for a married couple that files jointly, the first $500,000 of their gain is exempt. So that's the benefit that you utilize for a primary residence that you've lived in 2 of the last 5 years. In the event that you have a multifamily and a portion of it is your primary, but the other, as in this example that Martin's highlighting, 3/4 of it has been rented out, then we can actually bifurcate that transaction, and the taxpayer, the owner of that property that sells, can benefit from the Section 121 tax exemption as to 25% of the sales price. And then on the other 3/4, utilize the 1031 exchange to reinvest in other property and defer those taxes. And in this particular case, it's somebody that's moving out of the country. So this highlights a whole bunch of strategies, but they're moving out of the country. Now, 1031s, the real property has to be within the United States, and some of the territories, not Puerto Rico though, by the way.
Interesting.
Foreign property can be exchanged for other foreign property. In this case, this client is moving to Ireland, and so what's interesting, it's been her primary for the last 50 years. She effectively has no basis in the property. If she just did an outright sale, and it's selling a little north of 4 million, let's just use a third as a rough number, paying over $1 million in taxes. So she's going to get Section 121 tax exemption on 25% of the money. She's not married. She will still have a little bit of tax liability on the primary 25%. But as it relates to $3 million of the funds, she is going to invest that in some passive property, passive income property, that she doesn't have to manage or operate, and they'll be able to just wire her some money to Ireland to, on a monthly or quarterly basis, as it relates to the investments that she makes. So lots of
Wow,
flexibility and strategy around that.
that's great. So for example, in this case, and I don't know if she was, but I'm assuming, or a scenario could be, she could have been a landlord for a number of years collecting rent on a monthly basis, which is a little bit more involved, if you will, right? And now she's able to, transfer this $3 million tax deferred into another property that can be completely passive income. For example, I always use the land lease under Walgreens for some reason, but own a building that has a triple net, triple A tenant in, or something like that, right?
That's exactly right. So in her case, she's going to actually, as I understand it, because it was referred to me by a financial advisor, she's actually going to invest in what are called Delaware statutory trusts, which are more institutional grade assets, could be $100 million apartment complex. And she'll have co-ownership in that, and it'll throw off whatever return. And she's not going to put it all into one. She'll diversify into many. So that's the DST industry is north of $3 billion a year. So that's a pretty prevalent strategy for people, not necessarily for all their money. Oftentimes, and this is something this should not be scary to a realtor, because it's not going to substitute what you're doing. Oftentimes, people are going to sell a piece of investment property. They're going to say, hey, Martin, please find me. I'm selling for $4 million. 3 million of it's 1031 money. Let's find me something to invest in. I'd like to buy a condo that I'm going to rent out or whatever. And you may not spend all $3 million of it. You probably are going to do a great job negotiating for them, and they'll end up getting the property for $2.5 million. So in that case, that 500,000, if they don't reinvest that, they're going to have a tax liability on it. So that's sometimes where people also use some of these other strategies to take care of those residual pieces.
Got it. That makes sense. And now quickly, so I wanted to go back also. What is the definition of an investment property? Does it have to be collecting or being an investment for 2 years? Is that sort of the rule of thumb?
Great question. So you're sort of asking me two different aspects there. So what is investment property? It's really all about the intent upon acquisition, or at least as it now, somebody could buy something as their primary residence, and then they can abandon that primary usage and move to Long Island or Jersey or Westchester, wherever they're going. And and then they come to you and they say, Martin, listen, rent this thing out. I don't want to sell it just yet. I might move back in down the road, whatever. So then, of course, you would expect to see some income. Just buying something for the mere appreciation has been deemed not sufficient. So you do want to ideally see rent income from it. As we said, of course, depending on the asset, land is not going to be something you would expect to see that. There are many applications where, like myself, once upon a time, I did live in the city. Many people ultimately move out when they're starting a family. Maybe they hold that condo and start renting it out, or maybe they're a little bit older and their children might, getting out of college, move into that apartment. Those are situations you have to be careful of. Ideally, you would have fair market rent paid by the family member. You don't want that, deemed personal usage by the taxpayer. So again, if you just stick your kid or mom into the property, that's going to be deemed really the taxpayer's personal usage, and would sort of run foul of the 1031. But to your point, so it's all about the intent, and certainly collecting rent, evidences, and depreciating that property. Those are going to be good facts. You asked sort of about a time period as well. This is not for people that are flipping properties. So somebody that you sell a property to, they buy a condo, they fix it up, little spackle paint, and give it back to you a month later to sell. I know you love that. Earn your commission when they're bought, and earn your commission on the way out. But their intent was never to hold it as an investment. Their intent was always to resell it. So that would be a situation that would be problematic for them. Also, a developer, somebody that buys an apartment building or builds an apartment building, and they have all these condo units. that's going to be inventory to that developer, to that taxpayer. That's going to be
Got it.
subject to ordinary income tax. But it's not to say that they can't hold 10 of those units on their books as investment. And in fact, hopefully they rent those out. And then at a later point, they should be able to sell those and do a 1031.
That makes sense. Got it. And then again, going back to kind of the time frame is because I think the law doesn't necessarily state a specific time, but 2 years is the general practice.
So we talk about like you're asking for a period of holding period?
Yes, correct.
Yeah, so we do talk about a 2-year holding period for a variety of reasons. There are some related party rules that look to a 2-year holding. I know we're going to talk momentarily about second homes / vacation homes and the revenue procedure for that, which uses a 2-year holding period. So of course that provides a little bit of consistency by way of the tax returns, creates some consistency about the depreciation. Time is only one factor though. I mean, I can show you a case where somebody bought something and held it for 11 years, but as I mentioned earlier, they acquired it with the intent to subdivide and they never moved some of those onto their books and records as investment. So although they held it much longer than 2 years, their intent never changed. It was to resell that. So you have to be careful about that.
Got it. That's very helpful. Very helpful to know and to talk about that. So yeah, let's talk about exactly, the scenario that we have is that somebody, it could really be we're talking about New York in this case, but it could really be, any city or any place where you have a second home that, traditionally what happens with a lot of second or third home buyers is they love the place the first couple of years. And then as time goes on or things change, they don't use the place, or maybe they use it a couple weeks a year. And it's, without sounding like a financial guy, it's an underused asset, so to speak. And people think about, well, the good news, it's appreciated, but I don't want to do the capital gains. So what would be kind of a game plan? And it sounds like it's kind of a 2-year game plan. What's a game plan for them to do towards a 1031 on this, Eric?
Well, so there is, as I mentioned, a safe harbor, as we call it, that creates a bulletproof transaction that should stand up to any scrutiny, whereby if the investor does not use the property personally more than 14 calendar days, or 10% of the amount of time that they've rented it out for the 2 12-month cycles before they sell, and they in fact rent it out for at least 14 calendar days, and then do that on the replacement property, same thing, limit their usage and in fact rent it out, that should stand up. Now, as you said, if they're coming in, for 30 days over the summer to hang out and, have fun, that's going to be too much usage, right? And, you do want to make sure that it in fact has been rented out. So to your question earlier, you ideally just stop using it and start renting it out. And,
right.
It's not for me to judge or to say this is a sufficient period of time. Ideally, yes, probably more than a year and a day. It's definitely up to the taxpayer and their hopefully accountant to weigh in on it, and or their tax counsel to provide guidance as to what they feel is sufficient. So some people are a little bit more aggressive. This also works on the replacement end of the transaction. Oftentimes people sell their piece of raw land or their shopping center and they buy a condo in Manhattan, right? And they can do that through the 1031. And of course, it has to be held for investment. So again, ideally, they rent that out for a long time. That's my canned answer. As to when they start using it personally and or ultimately move into it, again, that really should be a conversation with the accountant. It shouldn't be their intent to be doing all along. And so I will sometimes get a question, and I know attorneys will get a question, and the person will say, or they may ask you, Martin, they'll say, listen, I'm selling a shopping center in Florida. you got $2 million to spend in New York City. When can I move into this? That's not a good fact for somebody to email me to have memorialized. So, that's
right.
the
And I
contrary,
agree.
that's the contrary intent. Now,
right.
there are a whole number of cases where people have had their children move into a property shortly after acquiring, and it stood up to challenge. I think in New York City, you definitely have to be careful about, of course, from building to building, and co-ops in particular, of course, typically don't let people rent, right? At least the first couple years, usually. Again, building by building board decision. But you're not going to get away with buying in a co-op, even if you could, and then sitting on it and just saying, well, I can't rent it out for the 2 years, so I'm just going to use it, or I'm going to just warehouse it for 2 years. It's not really a good look.
Right.
But again, that's not my call.
No, that makes sense. So the scenario would be is if you have a property, in this case, let's say New York, condo in New York, or a second or third property anywhere that you're not using, you would want to rent it out at the market rate for around 2 years. You would talk to your accountant, but 2 years seems to be the magic number. And then after those 2 years, you can then sell it, right? And then you could buy something else, and all the capital gains and all the taxes would be deferred. And kind of the beauty of the 1031 is you can do this indefinitely, right? So
yeah, this is not a one-time proposition. You can do this over and over again. We have an expression in the industry: swap till you drop. So you can most certainly do it over and over. And so, yes, I think that's an important point to note. Now, do you want me to talk about some of, just real briefly, about the time periods and rules, because that can be challenging?
Yeah, I think that's really helpful. Again, this time always goes by so quickly. Yeah. So why don't you give us like a scenario of why don't we go back to this the example you have of the $4 million multifamily?
Sure.
Time frame and rules.
And so, she's supposed to close in a couple of weeks. And once she closes, and so I get a copy of the contract title report. If it's owned in a trust or an LLC, I'll get those respective documents. In this particular case, she owns it individually. So I get a contract title. We set up all the paperwork. I send that to the attorney as well as to the taxpayer. We get it all completed and back to us. We set up the exchange account, the trust here at the bank, and then the closing will occur. The money will get wired in to the exchange account. And then there are two critical deadlines that begin. 45 calendar days to identify potential replacement property. And also beginning when title passed to the buyer at the closing, 180 calendar days to acquire one or more of the identified properties. So those are the periods of time people often confuse them. I hear, oh, I know I have 90 days. I hear all sorts of stuff. It's 45 calendar days to identify. So, it's something that clock goes real quick. People should try to line their ducks up the best they can, at least get into contract on a replacement property, before that deadline, so they can sleep a little bit easier knowing they should be able to buy one or more of their identified properties. The other important thing to note is that to defer all the taxes, all of the equity from the sale, and again, I told you in this particular case, she did not have a mortgage, but let's say she had $1 million mortgage, and
right.
I of course created a little bit of a complex situation because she lived in a portion of it, but let's say it was a 4-family that they didn't live in. Okay, so selling for $4 million, let's say there was a $1 million mortgage. To defer all the taxes, the entire $3 million of equity would have to be reinvested in new replacement property, as well as that $1 million mortgage has to be replaced. So typically, typically the taxpayer is going to go get another mortgage with a financial institution or otherwise, but you're not forced to get another mortgage. If she was in the financial position to substitute fresh equity, you certainly can buy a new piece of property for $4 million all cash. So that's it in a nutshell. Lots of variations around that, but I think it's important to note some of those rules at a high level.
Right. No, I think that's great. And then also you can you can sell one property and buy, is it two or three? Is there a limit?
There's actually not a limit. There's some limitations around identification. So
Okay.
typically people use what we call the 3-property rule, where they are limited to listing 3. However, if a taxpayer wanted to list more than 3, they can do that. But now, in addition to the replacement property addresses, they also have to give the fair market value, and it becomes capped out at 200% or 2 times the sales price. So in the example we've been dealing with, $8 million of real estate. But there is even a different exception for that, where you can list as many as you want, but you have to buy 95% of the fair market value of all of your identified properties. So if somebody were to buy, as we talked about earlier, like a DST, if there was one that had 20 triple net lease properties in it, you can do that.
Got it. Okay, well, that makes sense. So again, so for this $4 million scenario, you may want to spend, and it doesn't have to be exactly 4. It has to be a minimum of 4. It can, of course, be greater.
And it's not all or nothing, though. So we position it as, to defer everything, you have to reinvest all the equity and replace all the debt. But to your point, if she only wanted to reinvest $3.5 million, that's okay. And you just open yourself up to some taxes on the $500,000 that you didn't reinvest. So it doesn't, it's not all or nothing, doesn't blow your whole 1031 if you don't reinvest and replace all your debt.
Wow, that's great. So that's good to know, right? Because there's a lot of financial, and again, I'm not a financial advisor, but a lot of financial advisors are saying, look, capital gains have been the lowest ever. It's only going to go up. So maybe this is a good time to cash out some of that now, or if you want to use it for something else. So that's great. It's a really great tool for all this stuff. And thanks. Is there anything else you want to touch base on? Again, this half hour always goes
not
by
to open
so
a
fast.
can of worms, but because I see we're coming up against our stop here. But we've been talking about what are called forward delayed exchanges, which are called 95% of the transactions in 1031, where somebody sells their property first, typically because they need the money from the sale to fund their acquisition. But I could share a quick story with you. I have somebody that was trying to sell a property. It was a condo on the Upper West Side. I don't know, one case the buyer fell through. This is all started in the beginning of COVID. And then in another case, the board rejected. So long story short, they already had a property in Hoboken that they were planning to acquire as investment. So we were able to structure it as what's called a reverse exchange, where you actually buy your replacement property first, and then it flips all the clocks and it gives you 180 calendar days to sell one of your existing investment holdings. So I really boiled that down to a very high level. It's more complex.
Yeah, you did.
But that's the spirit of what it is.
Wow, that's great. Well, thank you so much, Eric, for shedding light on this. And it's a really valuable tool for people who want to defer their taxes, capital gains, income, everything else. You've been really great, and I really appreciate it. And again, thank you everybody for joining Ask the Expert series with the Martin Eiden team, and we'll have another expert next week. So thanks again. Hold on for a second, Eric, after this.
Terrific. Thank you, guys.
All right, that was great.